Hello, everyone. Welcome to today's session. Let's get underway. Let's just go over a quick market analysis here, see where we're at today. Market conditions. We're still bullish in this bull market, massive run up. Talked about it in this morning's update, and we've got momentum now that is approaching this upper range, starting to get extreme right here after 3 or 4 weeks of just straight up price activity. And now what we're looking for is whether or not we're going to get just a little pause right here or some type of a reversal or a significant reversal. Sentiment is sitting right up at this upper range. That traditionally is a location where we get some kind of pause. We can bump up a little bit higher here, but we're in that area. We're approaching that area now where we've gone from straight off the bottom, straight to the top, really with no pauses along the way. And ultimately that's creating really bullish market conditions. We'll look at the overall sentiment right here as well, but we're also seeing volatility down on this other side here. We're seeing bonds move all the way to the upside, so we're seeing equities and bonds to the upside, volatility to the downside. I think we've got crude oil, which is bottoming out, kind of bouncing here as well in some of those extreme ranges to be considering. So if we take a look at S&P 500, if we look at SPY and see where that's at in relation to where it's been, we're in this overall uptrend, but let's look at the 1-year time frame. We bounced aggressively off of this low, this 410 range support area, and now in this upper momentum zone here as well. We could certainly retrace back to this 439 range. That'd be a next level of support, at least based on this time frame of this swing low and this swing high point, retracing all the way back down inside that buy zone, that 50618 buy zone. And you can see how much support there was, price activity here. And we had some other things obviously happening with CPI and interest rates and even oil prices that have been pulling back down. So we'll see what the market will give us here in the next few weeks. We've got a gap now to deal with. Typically gaps will get filled, but that could take weeks or months. Sometimes it doesn't necessarily have to happen within this overall counter trend here. But we'll see what kind of pause we get right here and what kind of price action that ends up taking. If we get a pullback into that 439 range, that will be a good dip buying location. That'll pull the momentum back into that buy zone as well for markets. If we look at the sectors, we've got sector ETFs, which are all bullish now across the board, minus these two, healthcare and energy, which have been kind of lagging right here. Energy lagging more so with oil prices pulling back down. Healthcare had kind of led the way in the last 6-8 months, and then once it bottomed out, hasn't really gotten any momentum back to the upside as well. So technology, consumer services, industrials, transportation, those are leading based on those ETFs. So we also have commodities. Let's just review on those. Gold, which has been moving higher, but has retraced back a little bit here and now working towards that upper momentum zone. Always nice to see, this market. Gold went from this low to this high, similar to the S&P 500, and could use a retracement. So we could see, even if the markets retrace, they could retrace back to that pretty decent range, with how fast they've moved higher. And but nonetheless, gold it's got a pretty good looking bullish pattern here. Now we'll see if we can continue. If we can get up into that upper momentum zone, which is connecting this low or that high and that low, and it's pulling this 382, this 236 is that momentum location. We want to get up above that again, and then see if we can find some support there as well. That's on gold. Oil has been retracing pretty significantly also, and a big sell-off today. Wow, 5% back down to the downside. So we're seeing oil really move lower. That doesn't bother me, other than a few oil stocks that I've got that are either getting stopped out or approaching it. And we'll see if oil continues to move that way in this 2-year time frame. Let's see if we've got any real major support. This overall uptrend, we've got major support happening, really not until about right here, about almost where we're at right now. and then just a lot happening right through this entire range right here. So we'll see if we find some support in oil, and ultimately if that does create an opportunity for more upside. Let's grab that trend. If we grab this current trend just from this low point here to where we're at now and see about where we're at. So we're right at that 618, kind of blasting through it even. So we'll see if we get, and we're deeply oversold. Momentum's all the way to the downside. We'll see if we get any kind of pause that might, rally back up. And if we get some activity around here, we could see oil start to pause. But not yet. It's definitely in this downtrend and continuing that overall downtrend. Remember that as stocks or really anything, an ETF, a commodity, a market, as they're breaking down support areas, then those support areas become a resistance area. You can see that once this gapped lower and moved back up again, that underside of that support area now became a resistance level, and then we started this back down again. So now it's just, just creates more and more work for this, for the stock or whatever. In this case, it's USO ETF for oil, to be able to find that resistance and then start to work its way back up again. That's kind of a quick analysis there on commodities as well as the current sectors. And if we look at the market sectors, we're seeing bonds. If we go into this 6-month time frame, bonds have moved up above in this first area. This again, we're in a downtrend on this time frame, so we're counter trending back up into that resistance zone. It's bumped up above that. What is that number? 87, and then working its way back to that 90. So again, think of that stair-step approach where it clears one level, maybe retests it, finds support, heads to the next level, and it may find some resistance, break through that level. Once that level gets broken through to the upside, then it can pull back and find some support here and retest that area for more upside. So when we're climbing that ladder this direction, it's the stock has lots of work to do, because there's a lot of rungs in the ladder, so to speak, or stairs on the staircase that it's got to climb. When a stock is already in that uptrend and it's moving higher and it's retracing, then it's bouncing off these. These are dip buying opportunities. These are a little bit harder dip buying opportunities unless it's, we're looking for these pullbacks here, a support level and then the next move higher, support level and the next move higher. They can certainly be sketchy as those are unfolding towards the downside. Even on that 1-year time frame for TLT, we're back up above that 236. Remember that 236 can be the momentum location to the downside, just like it can be on the upside. So we've counter trended back up into this area. You can see it tested it once, it tested it twice, and then it finally broke out above that $88 range. So multiple levels, multiple time frames that are showing that area of resistance starting to happen on TLT, and that should be, over this time frame, it could really, if interest rates start to pull back down, then we really could see a nice rally in bonds. What would make interest rates move back down? Several things. Number one is the CPI numbers, inflation. That's what the Fed's trying to do with interest rates, is they're trying to maintain a lower inflation rate. Was up at 8% and has pulled back significantly. So we could definitely see a decent rally in bonds, maybe something to this magnitude here. Magnitude like that or magnitude like that. And you can see we've done maybe half of that move, and there's some major resistance area up there around that $93 range. So if we continue to see that, oil moving lower, equities moving higher, these market conditions have become quite bullish pretty quickly. They need a little bit of a pause here. So I would be watching for any type of opportunity for pullbacks on really on the major indices. Let's look at the Qs and see where it's at. This 2-year time frame, bouncing, still holding on to that downtrend from 2 years ago, and that overall move back down, rallied, retraced back into that. Let me see if I can snap over this direction. So inside that 236, or excuse me, the 382 support area, and making essentially attempting new highs right here, at least within this 1.5 to 2 year time frame. and really strong move here in tech this last run up. We're seeing that in S&P 500, but not quite as aggressive. You can see where the highs are. We've got this most recent high at 459. We've got this high at 480. So what does it all mean, right? In terms of market analysis and market direction, it can do a couple of different things for us. As we move back into an uptrend in a bull market, that essentially can help us with position size and allocation towards equities. Let's say that I have $100,000 invested and market conditions are bearish and they're continuing to move lower. What that might mean for me is it might mean I've got, I'm selling my losers, so stocks that are losers, I'm getting out of, and I may even set targets or tighten stops on winners as things are starting to weaken and raising more and more cash. And in this case, as markets start to move higher and we're in this overall uptrend and we start to trend back up, then, and even back here, as things have turned the corner and moved back up, we can allocate more and more towards equities. Okay, instead of we never want to have, in my opinion, all in. At least in individual stocks, you may be able to go all in on something really diversified or a balanced type of approach. But in this case, if we're in an uptrend and equities are moving nicely, then we can have a little bit higher allocation. Maybe our position size goes from 1.5% to 2% in a downtrend or bear market to 2.5% or 3% in bullish markets. We can take just a little bit bigger position size as markets are moving higher and approach it that way. So in terms of market direction, and I got a question regarding money management inside of 401k plans or retirement plans where you can't do a lot of individual stock trading and it's primarily ETFs or mutual funds. That's fine, because in the long term, the vast majority of time, being well diversified is going to be just fine. A lot of the 401k plans, that's really all you have to be able to do is change from your percentages from equities back to bonds or certain percentages. That's an entirely different topic though, because that's a little bit different approach when it comes to the kind of long-term investing that you're doing. 401k money, something longer term, that is a lot longer term. If you're in that time frame where you're using that money and you don't want to have that volatility and risk, then obviously it shouldn't be invested in something that has volatility or potential volatility. And even cash right now, cash and bonds, it's still paying 5-6%. There's nothing wrong with that. Especially if inflation is starting to come back down. So now we're seeing, inflation that may be coming back down a little bit, and equities that are in a position to be able to outperform cash or bonds or something like that. Just making sure that you're balanced and having diversification really towards, you can include that in your trading plan as well, to say, I've got X amount of money, I've got $500,000 in my retirement plan, and I'm in retirement, okay, and I need that money. I'm living off that money. That's an entirely different game, because you need that money and you need it to be consistent. You cannot afford losses, cannot afford even volatility sometimes in those situations. And so the time to be aggressive is not at that moment in time. It is certainly understanding what amount of cash you want to be able to have longer term versus try and grow that money. The goal is growing the money. The goal is not to be invested in stocks or invested in bonds or invested in cash or invested in REITs or invested in whatever it is. It's the goal is to grow the money. So whatever vehicle it's going to be required is really what you're looking for, and that can include a lot of different other strategies as well around trading, whether you're utilizing selling put options or shorter term directional type trades. That's got to be a component of the overall plan. The big plan is, what do I want? What are my needs with this cash? I have this capital and I've got to be able to do something with that. right now if I'm pulling money out of that. So it always makes sense to have a certain percentage or in equities and being able to try and grow that percentage. But the risk is the volatility. The risk isn't necessarily what you're invested in. The risk is the nature of the volatility, and it's not even the volatility, it's the amount of time you have to weather volatility. So for example, and I'm just saying volatility in terms of the ups and the downs. If I'm right here and I've got 100,000 and I'm all fully invested and the market retraces by 10% and my account drops by 10%, and now I'm down at, let's call it 90,000 just to make the math easy. And now it's like, oh crap, I really didn't want to experience that because I'm pulling money out of that. I needed that money. Well, that money shouldn't be in equities then. It should be in something different. It should be in a cash type of account or something that's just a lot more stable. But if this 100,000 is a percentage of your $1 million portfolio, $1 million, then you're only 10% invested in equities, and that's a 1% decline instead of a 10% decline. That changes the game. So it's about position size and it's about allocation amount as well, based on what your goals are. Okay, so leading into that kind of leads us into the topic for today, and that is dividend paying stocks. And we'll talk about that. So I've set up a scan here called dividends. Let's look at the criteria on this. So I've got it set at $3. We can even move that higher because typically stocks that are that low are that low for a reason. And so let me actually pull that in. I want to change that because there were actually quite a few stocks in there as well. And I'm going to update that. So our settings on this now, we've got stocks that are higher than $10, market cap's 100 million. We could even bump that up as well. That's pretty small. So let me bump that up, see if that changed anything. That actually didn't change anything. So I'm going to, I think I had 500. Oh wait, that was volume. Okay, let's go here. Let's go 500 million and let's leave that volume right there and see what pulls up. Okay, I'm going to save that again. And okay, so now here's our criteria, and we've got dividends that are paying PE ratio of greater than 1, which means if your price to earnings ratio is greater than 1, then you at least have earnings, right? So at least it's earning something, and you've got dividends. So that's just a very base criteria. And from here, what we want is we also want stocks that are in an uptrend. So we want long-term trend up, and we want current buy signal is also up. So if we look through that group of stocks, now dividends. Okay, let's talk about dividends. I'm going to pull up this chart pattern right here on this stock. This is a transportation shipping stock. So, and the PE ratio on this is, or excuse me, the dividend ratio on this is 8%. So dividends, essentially a stock that pays out dividends, and if it's paying out an 8% dividend, these are annual numbers. So if you say, okay, I have $10,000 invested in this stock, and I'm going to receive 8% dividends on that capital. Okay, that's a pretty good return of a dividend payment, and typically companies will pay out their dividends quarterly. So inside your brokerage account, you own a stock, it pays out a dividend, they deposit the cash into your account. So it's an income generating methodology, and 8% is pretty decent. Okay, and now there's sometimes a trade-off between dividends and risk and volatility, not always, but in this case 8%. If that's what my goal is to accumulate dividend paying stocks, then ideally I want to have a stock that is also giving me capital appreciation. It's giving me upside growth in addition to that. Depending on the school of thought, some people are like, I'm just going to buy General Electric or Coke or whatever, and it's got a 2.5%, 3% dividend, and I'm just going to close my eyes because I'm going to get the dividend, but I'm never going to sell the shares because I'm just going to generate the cash on that. That's one school of thought. The other school of thought is I'm going to buy stocks while they're trending higher and receive the dividend payment as well. It's definitely a longer term strategy because you're not going to be trading in and out of stocks aggressively and try and receive the dividend payment on it, because you have an ex-dividend date where you have to own the stock by a certain time. And then if you own it by a certain time, then 3 months later, then you're going to get the dividend. So it's not a 2, 3, 4 month time frame type of strategy. It's a longer term strategy where you might hold on to something for a year or 2 or 3 or something like that. In this case, here's an example of a stock that has been moving higher, at least for the last year, and pretty nicely. So you're getting a stock that's gone from 20 to 40, essentially increased to 100% this year, and it's paying a nice dividend. So with that, companies that you want to focus on for dividends is you want to have solid companies that have good earnings, that are continually moving, that don't have real big hiccups in their earnings per share numbers, that are pretty consistent. And sometimes those stocks are a little bit harder to find, but this is a starting point to be able to go through and say, all right, what are some of the names in here? Do I recognize any? What sector are they in? Are they in uptrends? What's the dividend gap, for example? GPS, this is a clothing company, Gap, at the local mall. Then you can see here it had a pretty nasty downturn. The dividend on this is 4.5%. And so, but the stock went from $15 to $7. Would I want to own a stock for 4.5% a year that potentially could lose 50% of my value? Okay, that's always a risk. There's never a way for that not to be a risk, but I wouldn't necessarily just hold on to a stock. I would still want to use the same momentum strategies going forward that we've been discussing, but I wouldn't want to hold on to it just because it's got a high dividend. I can add that as icing on the cake if I want and say, okay, Gap has started to move higher back here in this last year, started to trend higher. So every single time you had a pullback and it was continuing to move higher, it never did really stay in that momentum range. So you can pick a location and say, okay, I'm willing to let a stock retrace by X amount, 50%. So if I'm in its current trend and it's moving higher and it retraces 382, I'm okay with that. Okay, it continues to move higher. Now it's pulling back again, slicing through our momentum zone, 382. So I've got to say, what level am I okay with the amount of volatility or price fluctuation to still retain that dividend? In this case, it's still an uptrend. That buy zone, that's that 50% 618 buy zone, it didn't quite get there, and then away it goes again. So I can use some of those retracement locations for my overall strategy and my money management, because there's nothing worse than getting to a situation right here where maybe you bought the stock right here in this upper range and it continues to slide and you're thinking, oh my gosh, what have I done? I just bought a garbage stock. And so and by the time you're sitting right here, you start to worry about this amount of price volatility. Unless I said, I'm willing within this overall uptrend, I'm willing to let the stock retrace all the way back to a 618 before I even sell it. Okay, so going into the trade, I would know that that's the amount of volatility I'm willing to accept, number one. Number two is I've got to be able to trust that method. I should say number two is how many shares do I buy based on that potential stop. If I'm buying clear up here and I'm saying I'm willing for this location all the way down here to be my volatility range, I am not going to blink an eye at this stock as long as it's above this range. I don't care what it does as long as it's above that range. That has to be my mentality in terms of the trading plan, so that my position size is not, I've got 100,000 in this thing and good grief, I just got, watching this thing bounce up and down and up and down. That can't be the strategy, or it's going to drive you crazy and produce additional risk and produce additional volatility. So going into the strategy and saying, I'm okay with, I want a stock in an uptrend, and in this case, I would really have to close my eyes to the signals. Not too bad. You're mostly in the hold range. It never really did give a sell signal. Let's see if it did on this trend here. It did back here a little bit. Okay, so again, I'm saying I'm not going to follow that. I'm following. I know that it could have some volatility. I'm okay with that. And this is going to be a stock that I can continue to hold on to. It ends up just continuing chugging higher. This last move from really from the beginning of October has been pretty nice. So adding into a dividend stock, first I've got to find a list of dividend stocks that I'm interested in. Let's look at this one. This is a REIT, because REITs are also good to be able to own for this reason. REITs are, if you're not familiar with that term, it's just a real estate investment trust. Essentially what it is it's a company that owns real estate. And there's lots of different ones. There's lots of really cool ones, in fact. You can buy a REIT that only owns storage companies. So instead of you having to go out and buy a franchise in a storage company, you can buy a REIT that owns 20 or 50 storage companies, and you're getting the value, you're getting the dividends that they're paying, and the rentals that they're paying, and everything that that REIT is owning. You know, they'll oftentimes own strip malls, or they'll own apartment buildings, or they'll own, you know, they're typically very defined on what they can own, and they're regulated pretty tightly, so they have to pay, I think they have to pay 90% back out to the shareholders or something like that. It's a very large number. So REITs pay out typically pretty good percentages here on their dividends, and they can be a good diversified type of investment as well. So if you're thinking, I really would like to own, you know, real estate without owning real estate, there's, you know, obviously there's pros and cons to that, depending on which TikToker you watch, and who or YouTuber you watch, and what the approach is and the mindset. But the ultra wealthy know exactly how to own real estate, and it's essentially they're borrowing the equity from that real estate, leveraging more equity from the bank, and then reinvesting it into more real estate, and then letting it go up, and then borrowing against that, and then leveraging. So it's the, you know, the REIT idea and ownership model doesn't allow for that, which is one of the biggest advantages of owning real estate. But it's a way to be able to do that and receive a dividend of 8%, which is not that bad, and receive some capital appreciation. In this case, this REIT also had some volatility, about 30% to the downside here. So again, it's about a risk adjusted approach to say, how do I want to own this stock or REIT or whatever it is, and allow for some of the price volatility and also receive that dividend going forward. You just have to have a plan for it and say, I'm not willing for this stock to lose 25 or 30% just so that I can receive an 8% dividend. You know, chances are it's not going to go down forever. And so you are getting, you know, so you can see that you can still see the amount of volatility that you can get even on a REIT. And so it's paying out some dividends. You're always going to end up with some volatility. So the mindset has to be, I'm owning it for the long-term dividend. I'm not owning it for the price fluctuation. I could trade around that idea as well, or own something that is already in that overall uptrend. Just a couple of thoughts on that for dividends, and ways to be able to search for them and scan for them, in addition to just not the dividend. Maybe I want the dividend, but I also want these other factors as well. Maybe I do want some earnings, some additional earnings, or even better earnings. So I could say, you know, these guys are, this group, they've got current earnings that are working, they've got dividends that they're paying out. This is my selection that I can now go in and I can determine a little bit closer what angle I'm going to take on that. So dividend building portfolio for, you know, really, and you can create that scan just about any way that you want to be able to look for that. I could bump that dividend up to, you know, I've only got it at 3, maybe I'd take it to 5 and see what that pulls in. It's going to be less, right? And so I'm getting different things that are starting to rise to the top. If it's a REIT, you know, something like that, I could go in and I could do a little bit more homework and say, I want to understand this a little bit more, go out. So this is actually a healthcare REIT. So I can go out here to their website and look to see you know, what is it that these guys are buying? It looks like they're buying, don't know exactly quite yet, but it's in that healthcare, maybe nursing homes, okay, or something along that line, because you can get REITs that are owning different things, hospitals or strip malls, or in this case, you know, assisted living, or there's a ton of them, lots of different choices to be able to choose from, to be able to get that ownership, that dividend, and knowing what they're owning in addition to and in addition to how they're doing it. So it's a way to it's another diversified approach to be able to buy into that, and that's a quick way to do a little homework on a stock like that. Let's see. Question here: are there dividend aristocrats, or maybe all that, or maybe it just depends on the individual stock? Yeah, there's really not. I mean, there's you could be looking. One of the things you could be looking for is you could be looking for just a a major mega cap type company. So let's look at that and say I only want billion-dollar companies and, you know, millions of shares traded and in an uptrend, and let's see if anything pulls up. Okay, so based on that, these are some really large cap type names. Blackstone, here's one, Phillips 66. You know, I don't know that I would call it an aristocrat, but they're going to be stocks that are not going anywhere. Okay, you know, an oil refinery like this, their dividend is 3.68. That's not too bad. I would still want, you know, again, I still want to manage my capital side of things. If I'm trading, if I'm longer term, it's not going to be as big of a factor, but I need to make sure my position size allows for, you know, 20 or 30% volatility on the share price alone. If I can't handle that, then I need to have a smaller and smaller position. It still ends up being about position size, even with dividend plays, because you can still lose significantly on the capital side of things, and that's going to happen on any stock. So there's really not an aristocrat. Sometimes these big oil companies, drillers, shippers, they pay out pretty nice dividends, and they can have volatile stocks as well. Nothing's going to go up in a straight line, but determine what that volatility range is for you, and say, I'm willing to accept 20-30% because I'm only investing 3,000 of my 100,000, and so 30% on 3,000 is $1,000. I'm okay with that amount of volatility to be able to work on building out a dividend paying portfolio. Good question. I'm going to end on that note. I appreciate your time and effort, and we will see you next time. Thanks a lot, everyone. Bye now.